Greetings. We are back covering the month of August in our video commentary series. It's been a difficult month to say the least, but I think we were probably due for a retreat. I've seen in many circles folks saying we've come too far too fast. And from a seasonality standpoint, August and September are historically some of the weakest months on record. We also had the Jackson Hole meeting where Chairman Powell said something very astute. He said, I'm trying to read the stars, or we are trying to read the stars under cloud cover. And I think that's a really good analogy to summarize what's going on. When you zoom out and look at history, it's not uncommon for volatility to cluster around some of these monetary policy regime changes. And of course, we saw an extreme version of that going from zero rates in the previous decade, let's say from 2021 back, to an absolute shock to the entire system, the fastest hiking cycle in 40 plus years, the highest rates of inflation that we've seen since the 70s. Everything that we knew to be true has done a 180. So it's a challenging investment environment. We've got a lot of good stuff for you this series. So with that, I'm going to share my screen and get into the slides. And I always like to tell you when I'm recording this, this is August 29th. Most of you will get this on Sunday, the 3rd of September. So again, if you see something that's a little stale, that's why. Okay, so this is essentially a look at asset class performance from the start of 2022. So this would be the start of 2022 through the close as of August 28th. So I don't know, what is that? Almost 19 months worth of performance data. And we've got the S&P in here in orange. We have international stocks. We have the NASDAQ or technology stocks, intermediate term bonds, emerging markets, real estate, longer term bonds, and up at the top, gold. So I think this is good from a perspective standpoint. And back to my earlier comments, this has been a very difficult period. And I think this puts a bow on that comment, where since the start of 2022, if you're a diversified investor, if you own multiple asset classes, there's been it's a short list of places to hide. And the best performing asset class during that time has been gold. And a lot of that is due to inflation. But I think this would surprise a lot of people. As good as 2023 minus the month of August has been, when you look at the last 18 or 19 months, it really has been a challenging environment. And one of the most important points on why it's been so uncomfortable is this chart right here. It doesn't really matter what you've owned. Even beloved tech stocks here in green are down when you look at the last 19 months. More importantly, a lot of retirees, a lot of risk-averse investors rely on fixed income to mitigate some of this equity carnage when equities go down. And as you can see, long-term treasuries are actually the worst performing asset class on this screen. So fixed income has not been a safe haven. I've said this a lot. Higher unexpected inflation, higher interest rates are bad for all asset classes with few exceptions, gold being one of them. Looking at some seasonality data. So what this is S&P performance for the month of September here. The dark blue is the average of 93 years of data. So from 1928 to 2023. And you can see September, the month of September is historically weak, one of the weakest months on record. However, when the market is up 10% like it is in 2023, and this is for the S&P 500, September is actually positive. Looking at the last 4 months, so September, October, November, December, the average return for the S&P over 93 years of data is up about 2%. But when the market is up 10% like it is in 2023, it's much higher at 5.45%. So this is just one data point. I'm not saying this is going to hold true for this year, but some of these seasonality patterns tend to hold up over time. And it's just an interesting caveat to what's going on for the month of September when markets are up 10%, versus the average. And then when the markets are up 10%, what the rest of the year tends to look like. So again, this is just food for thought. Okay, this chart is the NASDAQ here in blue. So starting in August of 2021, so about 2 years of data, August 2021, as of yesterday's close, or as of last Friday's close, I believe. But this is the NASDAQ 100 index. Okay, it's been a pretty wild journey. And the orange is the US 10-year Treasury yield. Okay, but it's inverted. Okay, so as we go down, so this is the axis that is tracking the 10-year Treasury yield. As we move down, that means yields are going up. So you can see this. As this line has gone down, that marks the 10-year Treasury yield going up to about 5.25% as of this recording. This axis relates to the NASDAQ, okay? So you can see this relationship as of August 2021. In general, when the 10-year Treasury yield is going down, the NASDAQ tends to drift down. And you might say, well, why? A lot of risky tech companies are highly indebted, and higher borrowing costs, higher interest rates, higher bond yields can impact the cost of capital. Also, when yields are at zero, let's say, an investor might find it to be a rational trade to shun paltry yielding bonds and invest in riskier assets like large cap technology stocks. Okay. But an interesting thing has happened since, call it the spring of 2023. The 10-year Treasury yield has started to drift higher, while technology stocks have screamed higher. And you can see the big gap here in these two data points, which is unlike anything that we've seen over the past couple years, right? These lines track relatively closely for the reasons that I just stated. Many people think that AI, the AI-fueled boom, has caused this gap between US 10-year yields that are drifting higher and the NASDAQ drifting higher. So the question is, and I don't know the answer, the question is, do these lines converge again? Does the AI rally phase out? Does the 10-year yield drop? Okay, so something has to give here based on the last couple of years and based on the historical relationship between yields in debt markets and some of the riskiest corners of the market. Okay, there's a lot going on in this chart, but it's actually quite simple. So what we're doing now is comparing the S&P 500 forward 1-year performance versus the relative attractiveness of bonds versus stocks. And I will explain this. So this pink area, all right, this represents when the 10-year Treasury yield is higher than the earnings yield for the S&P 500. And the earnings yield is simply a metric people use to track the relative attractiveness of equities versus bonds. So earnings yield is how stocks are priced relative to bonds. And all earnings yield is earnings per share divided by price per share. So when earnings yield is high and the price per share is low, historically equities are attractive. Okay. When earnings per share is low and price is high, historically that means equities are unattractive. Okay. So that's just the earnings yield. What we're going to be doing is comparing the earnings yield, the relative attractiveness of equities versus the relative attractiveness of bonds. So investors, again, don't just look at are stocks cheap, are bonds expensive, or vice versa. They're comparing investments. Are stocks cheap versus bonds? Are bonds attractive versus stocks? And that's all this is. So again, the pink is when the 10-year yield is higher than the earnings yield, right? So in this environment, bonds or bond yields would be more attractive than stocks, more attractive than the S&P. The green would be the 10-year yield is low and less than the earnings yield. So this would be like a low interest rate environment. And if you've heard the acronym TINA, there is no alternative to equities. This is where we basically lived post-financial crisis. Interest rates were extremely low. Bonds were less attractive relative to stocks, less attractive relative to the S&P. And in this type of environment where bond yields are low, rates are low, the S&P averaged 1 year performance of 8.35% and was positive about 80% of the time. And this goes back to 1962. Okay. Now, I find this interesting because the narrative is when bonds are attractive versus equities, then equities should underperform, right? If something else is more attractive, that usually means something else is out of favor. And I found this very interesting. These are basically identical. So again, the pink is when bond yields are high or more attractive than equities, more attractive than the S&P earnings yield. And you can see these numbers are virtually the same. 1 year average performance when bond yields are higher or more attractive than equities, the performance is actually higher than the opposite. Now, the frequency of positive performance is a little bit lower, but these two numbers are quite similar. So if you were to draw a conclusion, equities can do well when interest rates are low. Equities can do well when interest rates are high. Sure, the frequency of positive performance is a little bit higher when interest rates are low, but certainly this narrative that stocks are less attractive and they have more competition from bonds because bond yields are higher doesn't hold much water when you compare it over the last, when you look at the data over the last 50 plus years. Keeping with the spirit of fixed income, there's this narrative out there, and I've said many times that bonds could use a PR makeover. Bonds did not hold up their end of the bargain in 2022. Equities were going down. A lot of investors were nervous. A lot of risk investors owned bonds because bonds historically have held up well when equities go down. And again, bonds did not hold up their end of the bargain. In many cases, bonds were down just as much or more than equities were in 2022. Bonds this year are grossly underperforming equities. And it's not like bonds should perform in lockstep with equities. I know that's absurd. But bond returns have basically been flat this year. A lot of investors are abandoning ship, looking for other asset classes rather than bonds for their capital. And I think that could be a mistake when you look at empirical evidence and you zoom out. So what this is, and I've shared this before, either in a blog or in a video, but I think it's very timely. And this information goes back 1976 to 2015. And basically what we're tracking is the starting 10-year Treasury yield. We break it down by decile. So over here would be the highest starting yields for the 10-year Treasury. Over here would be the lowest starting yields for the 10-year Treasury. And from these levels, we're tracking 7-year annualized performance. Okay? And this is 7-year future annualized performance for the Barclays Aggregate Index based on the starting 10-year Treasury yield. Okay? So, a caveat. Projecting future equity returns is impossible. Very hard, especially in the short term. It's even hard in the long term, although it's less hard. Projecting forward bond returns is much more predictable because, as we're going to see here, the starting bond yield tends to explain or predict much of the bond's performance over the next 5 to 7 years, let's say. Let me show you an example. So the 10-year Treasury is hanging out in this neighborhood right here. Call it this neighborhood right here in decile 8, between 4 and 4.6%. As of this recording, the 10-year Treasury yield's right around 4.25 or 4.3%. Okay, 7-year annualized return is 5.3% for the Barclays Ag Index. So every year for the next 7 years, potentially a Barclays aggregate bond investor could get 5.3% annualized based on today's starting 10-year yield. Okay, so that's a lot of information. Basically, the higher the starting yield, this is backed by 40 plus years of data, the better future returns are for bonds. So current yield is a great predictor of future bond returns. And I bring this up because many investors are bailing on fixed income at the exact time future returns look better, potential future returns look better than any point during the last 10 to 12 years, let's say. So fixed income is not dead. Borrowing and lending is the oldest form of finance. This has gone on for eons. So I would caution those folks to take a second look at fixed income. There's potential value in fixed income. Fixed income is not dead. It's not going anywhere. It's the deepest, most liquid market on planet Earth. And it just required some more flexibility, some more nimbleness, a little more of a dynamic approach over the last 18 months than simply checking out and owning a passive index, let's say. Okay, we're going to stick with the theme of yields and bonds. So there's been a lot of talk about the yield curve inversion. The yield curve has been inverted for 301 days, so for almost a year. And what this is we're basically tracking the U.S. 10-year yield and the 3-month yield spread. So short-term yields minus longer-term yields. If it's inverted or if it's negative, that means the yield curve is inverted, meaning short-term yields are higher than longer-term yields. So the yield curve has been inverted for 301 days. Okay, so we're looking at all yield curve inversions going back from 1962 to 2023. Okay, so calendar days here at the bottom, the various instances of yield curve inversions and the length the yield curve was inverted from the first inversion to the start of a recession. So this is incomplete right now because we haven't officially, at least by the government's call, we haven't officially entered a recession yet. So this is incomplete. It's been 301 days since we first inverted in October of 22, haven't yet called a recession. You can see these other periods, these other cycles, how long it took for a recession to hit after the yield curve first inverted. And on average, it's 589 days. You can see we're about halfway there, a little more than halfway there. So this is again, there's no hard and fast rules. It's not black and white, but this is a caveat for those that think that we're out of the woods because the yield curve has inverted and we haven't seen a recession. That's not necessarily true. We're not out of the woods. The average length between first inversion and a recession call is about 600 days, so almost 2 years. So let it develop. This is not saying that we're not going to have a recession. It's not saying that we are going to have a recession. Sometimes these rules, these hard and fast rules, can take a long time to develop. So if you look at 1966, yield curve inverted, and it took, what is that, 5 years, 6 years for a recession to hit. Like that's not really a useful timing tool. Of course, you can backfit data to support or deny a narrative. So this is just an interesting data point. But for those that say we're out of the woods because yield curve inverted, we haven't got a recession, know that that's not the case based on this data from 1962 to 2023. All right. Now we're going to talk credit spreads, which is something that we track very closely. So what this is the S&P 500 in dark blue in the left axis. So you can see since June of 2022, the S&P's journey in dark blue. The red is high yield spreads. So basically a spread is if you take a risk-free borrowing rate, right? Call it the U.S. Treasury 10-year yield. Anything above that would be the risk premium for owning a lower quality bond. So a high yield bond is a lower quality company, and the difference between that company's borrowing cost and the 10-year yield, let's say, is the high yield spread. And in general, the higher that spread, the more risk in the system, the more things that could go wrong, the more stress in the system. The tighter that spread, the more risk seeking, the more risk on, the healthier the economy. That's kind of the long and the short of it. So a lot of people watch, including us, what high yield spreads are telling us. And during times of stress, and again, this is inverted. So this is high yield spread. The bigger the number, the more stress in the system for lower quality companies and potentially the broader economy. So as this red line goes down,
the more stress the market is exhibiting. And this tends to correlate highly with the stock market. So as things get better, spreads tighten, market usually goes up. As spreads get wider, as the market goes down, these tend to track very closely. Right now, given August was difficult, high yield spreads are blowing out a bit, market's down. But what's interesting about this, if you look at the high yield spreads and go back over the last couple of years, they're relatively tight compared to some stressful points over the past year, let's call it. So what this is saying is high yield spreads aren't signaling, aren't flashing red just yet. They're not even potentially flashing yellow just yet. So there's been a lot of talk about higher rates could lead to a credit event. A credit event is essentially a default. So companies, governments that can't pay their bills, consumers, households that can't pay their bills. A good barometer to track that and to watch that are what high yield spreads are telling us. And this is not a blowout yet. If you go back, again, there's been worse points over the past couple of years that signal more stress in the broader economy. And this is something we'll continue to watch because, again, fixed income markets, the high yield spread markets tend to be very sharp. They tend to lead equity markets. So before things break down in equity markets, usually high yield spreads will smell it out first. Okay, switching gears. Those that follow us know we're big on investors building an information filter. I'm not gonna belabor that point again, but this is just a microcosm of what we're dealing with here in this country. And I wrote a blog about it a few weeks ago, how more people are spending time glued in front of the TV or doom scrolling on their phone, watching horrible headline after horrible headline. And it does start to seep into the human psychology of the way we view the world and the way we potentially view investing. So I found this Twitter exchange, as a great microcosm of that problem, where this person, Catherine Rampel, said 6 in 10, so this is a survey, 6 in 10 regard unemployment as a very or somewhat serious national problem. In the very next sentence, she links a government report that unemployment is very close to a half-century low. So what people perceive to be true based on what they're reading or watching and what's actually true, there's a pretty big gap there. And this person picked up on this. And many smart people are starting to pick up on this, where Joe says, I don't think it's crazy to suggest that the media is focused on negative aspects of this economy might be playing some role here. He further goes on to say, many Americans say they're hearing mostly negative economic news. About 4 times as many say that economic news has been positive. So 4 times the amount of negative news versus positive news. And again, this starts to seep in to the way people view the world. And it doesn't line up with history, right? I think the most, like I've backtracked. I used to think the worst investing trait used to be the fear of missing out, which is basically performance chasing. I now think, and this is my personal opinion, the worst investing trait is pessimism. Perma-pessimism, in my opinion, is the worst investing trait, and I'll show you why. So this is S&P total returns, the percentage of times returns have been positive over various time frames. So this is simply the percentage of times the S&P is positive over various time frames. And this is since 1928. And I could shut up and let a picture tell this story, but for those that want an explanation, it basically says the longer that you're invested, the higher the percentage you're going to have a positive or favorable outcome, a positive return. And some of these numbers are surprisingly high. Like I've seen this before. I've shared this in a blog a couple of years ago. But how this reads, if you're invested over any rolling 5-year period since 1928, you have almost a 90% chance of seeing a positive outcome, a positive return. If you're invested 16 plus years or even 15 plus years, it's a virtual certainty based on data since 1928 that you're going to see a positive return. So I know it's alluring to be scrolling Twitter, to be scrolling your phone, to be watching CNBC and Bloomberg 24/7, to read the Wall Street Journal, to listen to hot takes, to listen to predictions about the market going up 20% or down 30% next quarter. But when you zoom out, a lot of that behavior becomes destructive because it starts to shape the way that you view the world. It starts to shape your investment style. It starts to prompt you to act. And in general, humans would be better off erring on the side of doing nothing rather than acting, because the more decisions you make, especially the big decisions like market timing, selling 100% of your equities and going to cash and waiting for a better opportunity, the more likely you're going to be wrong. And that's just the sheer math of it. The more decisions you make, the more big decisions you make, the more likelihood that you're going to be wrong. So I'll say it again. The worst investment trait is being a pessimist. And this is supported by almost 100 years of data. So be careful of what you consume, because as we've seen from the previous slide, it does affect the way people view the world. So look, there's still many issues and unknowns to contend with. China's got a weakening economy, higher interest rates. No one knows the full impact of that because there's a lag effect. When the Fed goes from zero rates to the highest rates in 40 plus years, things tend to break. Inverted yield curves a cause for concern. There's mixed signals from the U.S. economy. You know, there's signs of positivity, there's signs of negativity, but a lot of it is unbalanced. Like I said, volatility, market stress tends to cluster around some of these pivots in Fed policy. On the positive side, earnings have been decent. The economy's been pretty resilient. I mean, the Fed's gone from zero rates to 5%, and we haven't had a complete meltdown. We haven't had an absolute recession. And it's fair to say that the worst of the hiking cycle is probably behind us. The Fed's not looking to just set their watch to future hikes. Now they're looking at the data. They're close to pausing. They've already paused once. So in general, there are certainly things to worry about, but I think when you look at the data objectively, it's pretty amazing what the Fed has done and managed not to crash the economy. And last year was deeply uncomfortable for investors. This year has been much better. Certainly the month of August has been difficult. But when you zoom out and look at things objectively, it's not all doom and gloom. So I hope you enjoyed this. I try to drop empirical evidence and market data to help you balance things out. I know many of you are clients. Many of you are reading a bunch of stuff, and I think it's important to understand where we're coming from and the things that we're watching. So if you have any questions, if you have any feedback, feel free to send us a note at insight@peerportfolios.com. We'll see you next month. Bye-bye.